All right, let's just jump right in. When you look at an agricultural giant like Nutrien trading right around 68 bucks a share, a massive question immediately jumps out of the data. Are we looking at a heavily discounted value play? An unpolished gem hiding in plain sight? Or is this a value-destroying commodity trap, just waiting to catch unsuspecting capital? Well, welcome to this explainer. Today we're going to tear apart the financials and find the exact answer, strictly following the data to cover all the points.
Here's our roadmap for today. 1. The ultimate valuation gauntlet. 2. Exposing the red flags. 3. The hidden green flags. 4. The billionaire reality check. And 5. Moat and final verdict. Let's get to it.
Section 1. The ultimate valuation gauntlet.
Okay, let's strip away all the market noise and stress test this company's baseline financials. Right off the bat, the contrast here is fascinating. You've got a very accessible stock price at $68.24, which gives us a market cap of around $32.5 billion. But look at that enterprise value, $44.68 billion. That $12 billion gap? Yeah, that's debt, my friends. We are dealing with massive, capital-intensive scale here, and that completely sets the stage for how we have to value this beast. To get to the truth, we literally ran Nutrien through 21 different financial models, spanning 5 distinct valuation groups. And seeing it all laid out really shows how wide the estimates can be depending on your investment philosophy. For example, if you look at Group B, the super conservative dividend discount models drag the bottom of the range all the way down to 34 bucks. But if you jump down to Group C's sector comparables or Group E's advanced real options, we see a ceiling of up to $105 a share. So we are spanning everything from a fire sale liquidation value all the way up to a fully optimized cash flow machine.
So what happens when we synthesize all 21 of those models? The math actually crystallizes beautifully. The average intrinsic value points to a blended fair value right between $74 and $78 per share. The key takeaway here is that at its current price of roughly 68 bucks, Nutrien is mathematically sitting in the fairly valued to slightly undervalued zone. We're looking at a 5 to 15% discount to its intrinsic value.
Section 2. Exposing the red flags.
But look, math in a vacuum? That's dangerous. Despite that favorable fair value we just calculated, we absolutely have to dig into the serious underlying risks. These are what we call the media blackout red flags, because mainstream coverage loves to fixate on year-over-year net income, but they ignore these 6 deep red flags. The absolute biggest one? Value destruction. Nutrien's return on invested capital, or ROIC, is sitting at roughly 6.8%, but their weighted average cost of capital, the cost to literally just fund the business, is 8 to 10%. In plain English, they're currently destroying economic value. It's like trying to fill a leaky bucket. Add to that a staggering 217% ballooning in short-term debt, over $1 billion in negative free cash flow in Q1 of 2026, and a top line that's still 26% below its 2022 peak. These are major, major structural strains.
And to really hammer home our 7th red flag, just look at the extreme volatility in their annual free cash flow. I mean, we went from a massive $5.6 billion peak in 2022, crashing all the way down to a $1.4 billion trough in 2024 before a slight rebound. That is a devastating 75% peak-to-trough crash. This proves unequivocally just how vulnerable and tethered this business is to the wild swings of global commodity cycles.
All right, Section 3, the hidden green flags.
Now, it's not all doom and gloom, right? To be completely objective, we have to look at the bullish case too, because there are 6 massive green flags working in Nutrien's favor that are flying totally under the radar. First up, smart financial engineering. Management is actively buying back shares below that $74 intrinsic value we talked about, and they've actually raised the dividend. Plus, they have significant net operating losses acting as a massive tax shield for future earnings. But the real magic is on the operational side. 49% of their potash ore is now mined using automation. That cements a huge low-cost advantage. They've also squeezed out about $900 million through portfolio optimization. And on top of all that, historical macro data suggests the commodity cycle might finally be bottoming out. So what we have here is the ultimate clash. In the red corner, we have that value-destroying 6.8% ROIC. But in the green corner, we have the hard, undeniable reality of a $52.32 tangible book value. And remember, we aren't talking about inflated software goodwill here. We are talking about actual physical potash mines, real nitrogen plants, and a massive retail network. This physical asset base provides a huge floor for the stock.
Section 4,
the billionaire reality check.
So how on earth do we break this tie? Well, let's put it to the ultimate stress test. We're going to run Nutrien's exact metrics through the strict philosophies of three legendary investors. First up, the father of value investing himself, Ben Graham. His philosophy focuses strictly on deep value, tangible assets, and buying companies so dirt cheap that you have an undeniable margin of safety.
Let's walk through Graham's mathematical checklist. Step 1, calculate the Graham number using earnings and book value. That gives us $76.04. Step 2, check the trailing PE. It's 13.8, which easily passes his strict under 15 rule. Finally, the margin of safety. At $68.24, the price is about 10% below the Graham number. Because of that rock-solid tangible asset base and the low multiple, the verdict is in. Graham would absolutely buy this.
Next, let's pivot over to Peter Lynch, the absolute champion of the growth at a reasonable price, or GARP, mindset. Now, for Lynch, a cheap stock doesn't mean a thing if the company's earnings momentum isn't there to actually propel it forward.
But when we run Lynch's checklist, wow, the picture changes entirely. The PEG ratio, measuring price to earnings relative to growth, sits between 2.8 and 4.6. That spectacularly fails his rule of staying under 1.5. On top of that 13.8 PE multiple completely overshoots their really sluggish mid-single-digit growth and 3.2% yield. Nutrien is simply not growing fast enough to justify the price. The verdict? Lynch would absolutely pass. Finally, let's channel the Oracle of Omaha, Warren Buffett. He's looking for quality compounders. He wants companies that generate sky-high returns on their capital without requiring massive, constant reinvestment just to keep the lights on.
Let's break down Buffett's test. At first glance, it actually looks kind of promising. The owner's earnings yield is highly attractive at roughly 8%, and the debt load is manageable. But look at step 2. The return on invested capital is just 6.8%. That feels spectacularly against Buffett's 15% minimum. Why does he care so much? Because a low ROIC in a highly capital-intensive sector like this means the business is basically eating its own cash just to maintain production levels. Over the long run, it destroys economic value. So the verdict? Buffett would pass.
Section 5, Moat and Final Verdict. Okay, so Graham buys, Lynch runs, and Buffett passes. Let's tie all these threads together for our final analysis. When evaluating their competitive position, we have to classify Nutrien as having a narrow moat. Yes, they are absolute giants, they possess incredible efficient scale as the largest fertilizer company on Earth, and they do have a distinct cost advantage thanks to things like automated mining. But here is the fatal flaw. They completely lack intangibles and switching costs. At the end of the day, fertilizers are a commodity. Farmers buy based on price, which leaves Nutrien entirely at the mercy of the global commodity cycle with practically zero pricing power. And that brings us to the absolute core takeaway of this entire explainer. The math suggests that Nutrien is sitting right at fair value, maybe even slightly undervalued. But because of the massive capital reinvestment required and that painfully low return on invested capital, this is a commodity cycle call. It is not a buy and hold quality compounder call. You aren't buying a predictable cash machine here. You are straight up betting on the timing of potash and nitrogen prices. Which leaves us with the ultimate question for you to ponder. When you look at Nutrien, what do you actually see? Do you see a classic Ben Graham discount anchored by deep, tangible assets and a wide margin of safety? Or do you see a declining value trap with extreme cash flow volatility and value-destroying capital returns? The numbers say it's fair value, but the business quality has some serious red flags. So which side are you on? Take this data, weigh the facts, and do your own homework.